There is a recurring contradiction in finance. A person with a modest, average income can quietly accumulate a multi-million-dollar fortune, while a high earner with an elite salary remains trapped living paycheck to paycheck. The decisions made today regarding a single paycheck eventually shape the long-term trajectory of a person's net worth. Financial success is rarely a mathematical problem reserved for the hyper-intelligent. Instead, it is driven by the way we actually think and act around money. Most resources focus on picking the right stocks or building a complex portfolio, treating wealth like a technical skill to be mastered. But if we look at why people fall into debt, interest rates are only part of the story. The rest is found in human emotions: greed, fear, and insecurity. Without addressing those impulses, no amount of financial literacy or insider knowledge can prevent a potential hit to your stability. Every person navigates the world using a highly restricted map, one built directly from their upbringing, their immediate environment, and their personal values. Your own experiences with money might make up a tiny fraction of what actually happens in the world, but they dictate roughly 80% of how you believe the economy operates. Regardless of education or how open-minded we try to be, fear and uncertainty reliably bias our decision-making. In the United States, low-income earners spend an average of $400 a year on lottery tickets. To someone with a high salary, dropping that kind of money on impossible odds looks like an objective mistake. But for those actively struggling to get by, that ticket is often a purchase of hope. It represents a dream that they cannot access any other way, making it a rational choice within their specific circumstances. While effort is a requirement for success, it often works alongside the invisible roles that luck and external risk play in determining an outcome. In 1968, Bill Gates attended Lakeside School, one of the only high schools in the entire world that owned a working computer. A single teacher invested $3,000 to bring that machine to the school. This specific event allowed Gates to develop a passion for coding years before most of his peers even saw a computer. At the time, Gates was part of a trio of computer prodigies that included Paul Allen and an equally brilliant student named Kent Evans. Kent possessed the same drive and intellect, but he died in a mountaineering accident before graduation. This tragedy illustrates the brutal, unpredictable nature of risk. This contrast shows that many life-altering variables remain entirely out of human hands, regardless of how much work is put in. Effort and intellect are not total safeguards against failure, as events entirely out of your control can shift a person's financial path. Authors Kurt Vonnegut and Joseph Heller once attended a party hosted by a billionaire. Vonnegut joked that their host made more money in a single day than Heller's novel Catch-22 had earned in its entire history. Heller replied that he had something the billionaire would never have: the realization that he already had enough. Recognizing when to stop moving the goalposts is a difficult skill to master, but it is necessary to avoid taking reckless risks. While capitalism is effective at generating wealth, it also fuels a cycle of envy and social comparison. When the goal is simply more, people eventually wager things that should never be at risk: reputation, freedom, and family, for the sake of a quick profit. Since there is always someone higher up on the ladder, the strategy changes from winning a comparison to refusing to engage in it.
Most of us assume that building wealth requires intense hustle, aggressive risk-taking, and frantic daily trading. Then there is Warren Buffett. His financial success comes from a very simple reality. He has been a consistently good investor for 75 uninterrupted years. His advantage is simply time. He built his financial foundation as a child and let it ride. Chasing the highest possible daily returns is exhausting. The real strategy is sticking to pretty good returns for a lifetime. That long timeline allows compounding to take over. Money grows agonizingly slowly in the beginning, but over a long horizon, it snowballs into an unstoppable force. True financial genius is a test of endurance. You step back and let the natural math of compounding do the heavy lifting, rather than constantly moving your money around. Getting wealthy requires taking bold risks, hustling hard, and maintaining optimism, but keeping that money demands a different set of skills. Retention requires humility. You have to maintain a healthy, constant fear that everything you've built could be wiped out in an instant. As investor Michael Moretz points out, you can never rest on past victories. You have to assume tomorrow will look radically different from yesterday. To survive, you must build an unbreakable financial foundation meant entirely to weather major, inevitable market crashes. You also have to build room for error into every strategy. Relying on a plan that demands perfect execution makes your entire net worth incredibly fragile. Long-term survival requires a strange dual psychology: fierce optimism about the distant future, paired with hypervigilance regarding the immediate threats directly in front of you. Take the story of art collector Heinz Berggruen. He amassed a significant collection and was praised globally for his flawless eye. He successfully secured undeniable masterpieces from legendary painters like Pablo Picasso. He also bought pieces by legends like Matisse. But the majority of his massive collection never became priceless. He was wrong most of the time. His collection illustrates a tail event. In almost any field, out of thousands of failed attempts, a single extreme outlier drives almost all the returns. Look at venture capital. When a fund backs 100 startups, they expect 80 of them to fail completely. The entire model relies on 1 or 2 generating astronomical returns. The stock market operates on the exact same math. A tiny fraction of companies generate the significant gains, while the vast majority flop. Because tail events drive everything, taking losses and failing frequently is a mandatory part of the process. It is how you survive long enough to find the rare winner. People often say they want to be a millionaire. Usually, what they actually mean is they want to spend $1 million. Constantly spending money is the literal opposite of building wealth. Being rich and being wealthy are entirely different things. High-income earners driving flashy sports cars are certainly rich, but they are displaying money they've already spent. The same goes for those living in large, heavily financed mansions or wearing designer clothes. These are visible performances of consumption. True wealth is completely hidden. It is defined by the assets and the money you choose not to spend. Once people reach a certain income level, they usually fall into one of 3 camps. They diligently save, they never think about saving, or they believe they earn too much to need savings. Your personal saving habits dictate your financial destiny far more than your raw income or your investment returns. Your saved, hidden capital provides immense financial firepower. It gives you the flexibility to buy what you need exactly when you need it. This allows you to stop performing for other people, keep your options open, and gain unshakable control over your own time.
Financial success is often framed as a contest of pure logic and spreadsheets. We assume executing perfectly makes us untouchable, but any plan that is strictly, coldly rational often fails to account for reality. The political scientist Scott Sagan observed that things which have never happened before happen all the time. Our history is a poor map for the future because the world is constantly being reshaped by events that have no precedent. Professional poker players survive by embracing this uncertainty. They don't look for guarantees. They play the odds while knowing the deck can and will produce results that go wildly off script. Navigating an unpredictable world requires a massive room for error. Building a buffer into your strategy is the only way to ensure that a single unforeseen disaster doesn't end your progress permanently. Because global shifts are unpredictable, your specific industry or job is never truly guaranteed. Betting your entire survival on a single paycheck without a fallback to catch you is a risk that most people cannot afford to take. Real security is found in a robust emergency fund. You need a stockpile of cash designed specifically to absorb the impact of rainy days that aren't even on your radar yet. We are remarkably bad at predicting our own evolution. The desires you have today will likely look very different in 10 years, making it difficult to commit to rigid, lifelong financial decisions. This evolution is often blocked by the sunk cost fallacy. We stay trapped in losing investments or failing businesses because we've already lost so much capital that we feel forced to keep pouring money into them. Survival requires the discipline to walk away. You have to be willing to cut your losses today so that your future remains protected from the mistakes of your past. Compounding wealth requires a specific price, but it isn't listed on a balance sheet. You pay for market success in the heavy emotional currency of fear, doubt, and constant uncertainty. Most of us overestimate our pain tolerance. It is easy to ignore the psychological toll of investing until you are in the middle of a market crash, watching your portfolio drop 20%. If you view market volatility as a mandatory fee rather than a punishment, it becomes manageable.
This mental shift helps you handle short-term turbulence without panicking and interrupting your long-term growth. Pessimism has a strange social advantage. It sounds smart. We treat warnings of impending danger as intellectual insights, while often dismissing an optimistic outlook as naive or confused. Daniel Kahneman links this to our history of survival. Our ancestors were biologically wired to prioritize threats over opportunities. Those who treated every rustle in the grass as a predator were the ones who lived long enough to reproduce. This biological fear often blinds us to how markets actually heal. When oil prices skyrocketed years ago, it looked like a catastrophe. In reality, that crisis forced the industry to invent revolutionary new ways to extract energy. Human creativity reliably follows a crisis. When a threat appears, it creates a massive incentive for innovation, turning potential disasters into new economic opportunities. The problem is that destruction happens in an instant, while progress takes a painful amount of time. Growth compounds slowly, step by step, but it only takes a single catastrophic mistake to shatter trust and value. Pessimists focus on the sudden, visible destruction, while ignoring the slow, invisible power of human resilience. They see the crash, but they miss the compounding. The ultimate goal of financial planning is personal independence. There is a deep, quiet joy in being able to spend your time reading, learning, and working out without worrying about the next paycheck. Housel chooses to own his home debt-free. While this might fail the mathematical test for peak efficiency, it passes the survival test by providing him with total peace of mind. To further insulate himself from panic, he keeps 20% of his net worth in straight cash. This ensures that even during a market emergency, he is never forced to sell his stocks to cover his expenses. This cash buffer protects the most important rule of compounding, which Charlie Munger stated clearly: never interrupt it unnecessarily. Minimizing the risk of failure is more important than chasing a single windfall. Because individual stocks can fail unexpectedly and interrupt your progress, the safest strategy for most people is holding low-cost index funds for the long haul. When you move past the pursuit of perfect rationality and embrace these behavioral tools, you gain control over your future. You stop reacting to market chaos and begin the massive transformations required for true financial freedom.